All right. Good afternoon, everyone. Thanks for joining us here for today's workshop titled, What Do You Need and When Do You Need It? A New Approach to Retirement Income. I'm Zach Przicki. I'm a member of GMO's Client Relations team. I'm joined by our two presenters today, Matt Kadnar and Martin Tarlie, both from GMO's Asset Allocation team. Some of you may know Matt from previous asset allocation discussions or fall conferences. And if you don't know Matt, you'll see tomorrow that he's a very talented MC when he MCs the main day of the conference. Martin focuses on investment research at GMO. He's written a number of pieces on investing frameworks over the years and has a seriously impressive bio. In addition to his PhD in theoretical condensed matter physics, he was also a fundamental equity analyst, so he's got skills on both sides of the spectrum, so definitely a smart guy. Today's presentation is about a unique and flexible framework for investing that Martin's been researching for the past several years and how that can be applied to retirement investing. There will be time for questions at the end, and with that, I'm going to pass it over to Matt.
Thanks, Zach. I'm also known as the one with the less impressive bio. It's okay. I still feel confident in who I am. But what we want to talk about today is basically a simple concept. And if you think about most investment problems that you face, the questions of what do you need and when do you need it frame those problems in a very nice and direct manner. And so we're going to talk about this framework today. And this is really an extension of some work that Martin and Ben did back in 2013, 2014, where we talked about using expected shortfall as a framework for managing glide paths. And so we're going to take that framework and apply it to many things. You can apply it to many things, but we'll focus today on retirement income. And Martin's really going to carry the laboring oar here. But what we hope you leave today with are the main points that the framework we're going to talk about is very simple and intuitive. And it captures the investment problem in a way that is simple and intuitive. And that the framework is important because we're trying to answer the right question. And so Ben talked about making sure when you're trying to solve a problem, asking the right question, his investment pet peeve. Well, we both work for Ben, so we're not complete idiots. You know, we're going to frame our problem in a right way where we ask the right questions. And if you ask the right questions, well, then obviously you're much more likely to come along the right solution as opposed to stumbling around looking for that chestnut. And two important aspects of the work that Martin's going to outline is that mean reverting portfolios, having an expectation of mean reverting returns in portfolios does have an important implications as we think about building portfolios. And then lastly, and it's related and a little bit counterintuitive, that bonds actually become relatively less risky versus stocks as your time horizon increases. And a lot of people think about retirement income, they think about fixed income and bonds. And as your time horizon lengthens, bonds actually will see empirically become more risky relative to stocks. But we'll turn it over to Martin to take us through the framework.
Thanks, Matt. So we're going to start today by introducing some of the conceptual ideas that underlie this framework. It's useful to begin by going back to kind of textbook modern portfolio theory and asking the question, how do we choose a portfolio using the standard conventional approach? So on the graph here, we have the standard efficient frontier, expected return on the vertical axis, volatility of returns on the horizontal axis. Now, the line here is the set of efficient portfolios. These are the portfolios that maximize expected return for a given level of volatility. If you are risk averse, if you have a high degree of risk aversion, you will choose the portfolio in the lower left-hand portion of the efficient frontier. Relatively low return, relatively low volatility. If you are less risk averse, you will move up and to the right on the frontier. You will have relatively high expected return, relatively high level of volatility. The way that we express how risk averse we are is through what's known as a risk aversion coefficient. Now, the way that this risk aversion coefficient gets utilized in the conventional framework is you maximize an objective function where the objective function says that you like return and you don't like volatility. And this risk aversion coefficient specifies how much you're willing to trade off return and volatility. But there are a number of problems with this approach. First of all, this risk aversion coefficient is not very intuitive. None of us really know what our risk aversion coefficient is. But more importantly, risk is not necessarily volatility. Risk, in our view, is not having what you need when you need it. So this risk aversion coefficient doesn't account for things that matter to investors. What's your investment horizon? How much money do you have? How much money do you need in the future? So what we want to do is we want to come up with a framework that naturally frames the problem in terms of what you need and when you need it. The way we're going to do that is we focus on the needs and circumstances of the investor. Really the motivation for this framework is to put the asset owner at the front and center of the investment problem. And we do that, and when we focus on the needs and circumstances of the investor, we're led to the following set of 4 questions. The first question is, what do you need? We address that question by introducing a target. Now that target could be as simple as, I need $1.50 in the future. It could be more sophisticated than that, which we're not going to talk about in this presentation. But as Matt mentioned, this is a very flexible framework. You can frame a problem in terms of, I need to beat the S&P 500 by 150 basis points a year. That is a valid target in this framework as well. So it's a very flexible framework. We're going to focus in this presentation on more of the dollars and cents. We're thinking about more of the retirement problem. I need a certain amount of dollars when I retire, or through retirement, I need my wealth to follow a certain path. So we introduce a target. The next question is, how much do you care about not achieving that target? To address that question, we introduce this idea of asymmetric preferences. Generally, you feel much worse if you are below the target than if you are above the target. You're much less happy. Your feelings are much stronger when you fall short than they are when you're above the target. That's asymmetric preferences. Third, of course, it matters what you have. Starting less than you need, you're in a very different situation than if you start with more than you need. And finally, the 4th question is, when is it that you need it? Now, to answer this question, it matters both when you need it and when you start caring about falling short of that need. So these are the 4 underlying questions. And to come up with a framework that addresses those questions, I'm just going to sketch out some of the kind of conceptual foundations of the framework. The starting point is to go back to your Econ 101 textbook and to start with utility theory. So we have utility, or an index of happiness, on the vertical axis, and your wealth on the horizontal axis. And we have a standard utility function on the dashed line. Now, the shape of this utility function is controlled by your risk aversion coefficient. This is the same risk aversion coefficient that's used in the conventional mean variance framework. But as I mentioned, what we want to do is we want to make a couple of modifications. The first modification is we want to introduce a wealth target. So that's indicated by the vertical line here. When your wealth is below the target, you're in shortfall. When your wealth is above the target, you're in surplus. Now, it turns out that if the only thing you do is add a wealth target, it actually does nothing. You need to do one more thing. And that one more thing is you need to introduce this idea of asymmetric preferences. The attitude that you have to falling short of the target has to be different than the attitude that you have when you're in surplus. Once you introduce a target and you combine it with asymmetric preferences, that's the driving force behind all of the results that we're going to look at. So in this example, the curvature below is more than the curvature above, and so you are more risk averse when you're in the shortfall phase than you are when you're in the surplus phase. Okay, so Throughout the remainder of the talk, I'm going to focus on one particular version of a utility function, and that's what we call the pure shortfall utility function. In the pure shortfall utility function, when you're below target, if you're 20% below target, you feel twice as much pain than if you're 10% below target. If you're above target, you're equally happy for all levels of wealth above the target. Now, the virtue of this pure shortfall utility function is it highlights the role of the wealth target and of asymmetric preferences. The heart of the framework, so once we combine these kind of conceptual ideas, what we're able to do is come up with an explicit objective function. This explicit objective function is really the heart of the framework. And the reason why it's useful is because when we optimize this function, out comes an optimal portfolio. This is the portfolio that we would own. This is how we actually construct a glide path, for example. But there are two categories of inputs into this objective function. The first category are the investor preferences. These are the things that we've already discussed. But the second category are your market views. You need views on expected returns, and you need views on volatility. But once you ask the question, when is it that you need your money, your investment horizon comes to the fore. When your investment horizon comes to the fore, it's not enough just to have a point estimate about a return or a volatility at a single point in the future. You actually need, you actually need to have a view over the entire investment horizon. That's what we call a term structure of expected returns and a term structure of volatility, and we're going to come back to that later. Now, another ingredient that we need is we need a model for asset returns. We start with a very simple decomposition of asset returns. We say the return is the expected return plus the unexpected return. Now, that doesn't sound like much. It sounds trivial, but it's simple yet extremely powerful. One of the ways in which it's powerful is it helps us make a distinction between constant expected returns. When expected returns are constant, that means that the asset prices follow a random walk and we're not able to actually predict future returns. However, if expected returns are mean reverting, as we think they are in the real world, then asset returns are in fact predictable. And what this decomposition allows us is to distinguish between the impact of assuming constant expected returns versus mean reverting expected returns, and we're going to investigate that shortly. So to get an idea about how investment horizon interacts with the concepts of shortfall and surplus, let's look at this following 3D picture. So this is kind of a cartoon to help you get a mental picture of how to think about the problem. So we have time coming kind of out of the screen and wealth into the screen. And imagine that we start at time zero with $1. That's what we have. What we need is we need $1.25. So we're saying that we start with $1. In 5 years, when we need it, we need $1.25. Now, we're going to invest in assets whose returns are uncertain. So we start with $1. We invest in these volatile assets. Over time, the range of outcomes expands. By the time we get to 5 years, the range of outcomes will have expanded to something like as shown here. The points in red are the range of outcomes where you've fallen short of the target. And the blue points are the points where you're in surplus, where you've exceeded the target. So this simple cartoon gives us a mental picture of how the investment horizon relates to shortfall and surplus. Shortfall and surplus. Okay. The last ingredient, the last concept I want to introduce is this concept of a target compounding rate. So in the example that I mentioned on the previous slide, you start with $1, you want $1.25, and you want it in 5 years. What you're saying is that you basically want to compound your wealth at 5% per year. Now, some problems are very naturally framed in terms of dollars and cents. Saving for retirement is naturally framed in dollars and cents. I'm going to save X amount of money per year. I want $650,000 when I retire. That's a dollars and cents problem, but we can turn that problem into an equivalent and implied target compounding rate problem. Other problems, like the endowment or foundation problem, are more naturally framed in terms of a target compounding rate. You're spending down at 5%. Maybe you want to keep the purchasing power of your endowment constant, so you need to compound your wealth at 5%. This simple formula helps us think about going back and forth between framing the problem in dollars and cents and framing it in terms of a target compounding rate. So now we have all the ingredients, we can start looking at an example. And the simplest example is to think about allocating between stocks and bonds. So we're going to ask the question, we're going to invest in stocks and bonds, how should we allocate? Well, we need to make some assumptions about what the asset class returns and volatilities are. For stocks, we're going to assume 6% real, standard US market history. For bonds, think of something like a 10-year bond that has historically earned about 2.5% over inflation. Volatility of stocks is approximately 18%. Volatility of bonds is about 7 or 8%. In this example, we're going to start by assuming that expected returns are constant. Later, we're going to modify that and say, well, how do things change when we assume expected returns are mean reverting? But let's start with the idea that expected returns are constant, and we're going to assume that returns are uncorrelated. So we're going to say the problem we want to solve is what portfolio should I own if I want to compound my wealth at 5% real. So we're going to fix the target compounding rate of 5%, and on the horizontal axis here, we have your investment horizon. The vertical axis, we have weight in stocks and bonds. So when you have a relatively long horizon, say 30 years, the optimal portfolio is a little more than 80% in stocks and a little less than 20% in bonds. As your horizon shrinks, weight in stocks falls. Now, you're probably looking at this saying, well, this is really no big deal. I've seen this 1,000 times. All the glide paths that you've probably ever seen look something like this. We think, however, that this is a very striking result for a couple of reasons. First of all, we have not directly used human capital in coming up with these portfolios. In any glide path that you look at that's out there today, the implicit or explicit assumption is they've used human capital to come up with the glide path. And we're going to come back to that a little bit later, but it's kind of a key conceptual point. Forgetting about kind of the retirement problem in human capital for the moment, let's just go back to the mean variance approach that I discussed earlier. If you take the problem of wanting to compound at 5%, assume that expected returns are constant, and use the standard mean variance approach, you will not get a glide path like this. Instead of this, you'll get a glide path that's completely flat. Your weight in stocks does not depend on investment horizon if you use a mean variance approach and you assume that expected returns are constant. So what's driving our result here is this asymmetric preferences. It's the idea that you have a target and you care more about shortfall than you do about surplus. That's what's ultimately driving this result. And so it looks familiar, but the reason is very different. Now, one way that we can understand those portfolios is to go back to the conventional efficient frontier and examine some of those portfolios and how they relate to the positioning on the frontier. So as a reminder, we start out with a frontier, and in the conventional approach, we specify our preferences by specifying the risk aversion coefficient. So if you had a risk aversion coefficient of 4.3, then you would have a portfolio with an expected return of about 5% and a volatility of about 9%. As your risk aversion goes down to, for example, 2.5, you move higher up on the efficient frontier, and as it goes down even more, you move further on the frontier. Now let's take some of the portfolios from the glide path that we just looked at and see where they fall. Turns out if you have an investment horizon of 5 years and a target compounding rate of 5%, that, in this example, is equivalent to a risk aversion coefficient of 4.3. If your horizon is 15 years, you move up and to the right. Again, we're fixing the target compounding rate of 5%. A 15-year horizon moves you up and to the right on the frontier, and that corresponds to a risk aversion coefficient of 2.5. As you increase your horizon further, you move further up and to the right. So this is very intuitive. As you increase your horizon, you are willing to take more volatility. You are willing to bear more volatility. But we're not viewing volatility here as a risk, we're viewing it as a cost. We're going to come back to that concept. So one way to view our framework is it gives you the appropriate location on the efficient frontier, but with much more intuitive specifications. All you need to specify, what's your investment horizon and what is your target compounding rate? And that will tell you the appropriate portfolio, rather than having to specify your risk aversion coefficient. Now, you might also say, well, I don't need to specify my risk aversion coefficient. I can just say, I want to compound my wealth at 5%. If you want to compound your wealth at 5%, that corresponds to an arithmetic return of about 5.6% because of the volatility drag. But if you want to compound at 5%, using the standard framework, that is only the optimal portfolio from an expected shortfall perspective if you have a 10-year horizon. If you have a longer than 10-year horizon, you should be further up on the frontier. You should be taking more volatility than is implied by the conventional approach. Okay, so to this point, we've assumed that expected returns are constant. What happens if we assume that expected returns now are time varying or mean reverting? As I mentioned before, once we bring investment horizon into the problem by asking when you need it, we need a term structure of expected returns, and we need a term structure of volatility. So to start, we're just going to start by looking at what does it mean to have a term structure of expected returns. Now, if expected returns are constant, then the term structure of expected returns is just flat. Your expected return at every point in the future is always the same. But if you have mean reverting expected returns, if you have a cheap asset, the initial expected return is higher than average. And as time evolves, you're expecting that expected return to fall and to go back to normal as valuations go back to normal. On the other hand, if you have an expensive asset, so that valuations are much higher than normal, you're expecting valuations to come down, so expected returns start out lower than average, but revert over time back to normal. So that's the term structure of expected returns. What about the term structure of volatility? So let's start by looking at the term structure of volatility for stocks. So on the vertical axis, we have volatility. On the horizontal axis, we have the horizon of the returns. So let's start with a one-year horizon. So with a one-year horizon, the volatility of stocks is slightly under 20%. Now the dashed line here is how that volatility term structure would evolve as you increase your return horizon if stock prices followed a random walk, or equivalently if expected returns were constant. For bonds, we have a similar picture, but bonds start out much lower. Bonds start out with a one-year horizon of a volatility of about 7 or 8%. But they too increase, like the square root of time, if bond prices followed a random walk, or equivalently if bond expected returns were constant. But what about the empirics? How does the world actually work? For stocks, when we examine the empirics of the term structure of volatility, what we see is that volatility is lower than you would expect if stock prices followed a random walk. Bonds, however, are the opposite. the volatility of bond returns actually increases faster than you would expect if bond prices followed a random walk or if bond expected returns were constant. And this result is really coming from an inflation effect. It's due to the interaction between expected inflation and realized inflation is the driving force behind this effect. So what are the implications of this? We'll get to that in a moment. To model the expected returns, we need to make assumptions about what the reversion periods are, but we also need to make assumptions about what the volatility of expected returns is. So this volatility of expected returns gives us another knob, and we're going to come back to that when we discuss alternatives. So we now have a richer model for returns and expected returns, and what are the implications of incorporating reversion into our asset classes? Well, in our simple stock bond example, what happens is, if you recall, for a 30-year horizon, when we assume that expected returns are constant, the stock weight was about 80%. Now it's moved up to 100%. And this is coming from the fact that bonds become relatively more risky as the horizon increases. And bonds only start entering into the portfolio at about a 15-year horizon. So accounting for the term structure of volatility driven by your assumptions about what the mean reverting characteristics of the asset classes are can have a very big impact on your portfolios. Okay, so that was a warm-up to what we want to talk about now, which is how you should think about investing once you're in retirement. So I mentioned human capital before. So human capital is kind of the conceptual foundation of all of the glide paths that are out there today. So this is a picture taken from the Ages of the Investor. And the basic idea behind human capital is very simple. Your human capital is the present value of your future earnings or wages or savings, however you want to look at it, they're all equivalent. You start out when you're very young, you have a lot of human capital. And human capital is considered like a bond. So the thinking goes, well, you're very young, you have this huge bond in your total portfolio. Therefore, you should have a lot of stocks to kind of have a balanced portfolio. As you age, your human capital falls, just as in the graph here. But once you get to age 65, you have no more human capital. Your human capital is zero, and it stays zero throughout your retirement. That implies that well, I mean, that's what the graph says. There's always a class clown. So this implies that the glide path in retirement should be basically flat. And when you examine the glide paths that are out there, they tend to be very flat. We're going to see an example of one a little bit later. In our approach, we utilize exactly the same inputs. So we take into account how much you're going to save, therefore how much you're going to invest, what your horizon is. So we use the same inputs that go into human capital, we just use them in a different way. The way that we use them is we back out what the implied target compounding rate is. So, for example, if you make standard industry-wide assumptions, as you're accumulating assets based on assumptions about savings, et cetera, you need to compound your financial assets at 5% per year. Once you hit retirement, though, we make assumptions about how much of your assets you're going to withdraw. In this example, we assume that you withdraw at 5% per year, but you need 30 years. So if you retire at age 65, our expectation is that you're going to live for another 30 years. If you withdraw at 5% per year and earn nothing on your assets, you're going to run out of money after 20 years. So in order to not run out of money by the time 30 years has elapsed, you need to earn 3% per year. So we don't have this issue of zero human capital once you're in retirement. What we say is your financial assets have to fill a need. And this need is you need to compound your financial wealth at 3% per year. Now, it's also useful to kind of take a step back and view the kind of life cycle of the investor through the lens of the fundamental risks that you're exposed to. So we think there are two basic risks, inflation risk and also depression risk. Inflation risk is simply the erosion of purchasing power. Depression risk is actually two-pronged. You can have a very bad market event and you can lose your job. When you're very young, you're less sensitive to both the inflation risk and depression risk because you simply have a long time. But as you approach retirement, you have moderate sensitivity to inflation risk, but you're very sensitive to losing your job, so you have increased sensitivity to depression risk. Finally, when you're in retirement, the primary risk that you're facing over the long run is inflation risk. You still have the depression risk component of a bad market event, but you don't have a job anymore, so you're less sensitive to that other component of depression risk. Now, once you're in retirement, it's also useful to get a mental picture about how does shortfall and surplus relate to investment horizon, just like we did for the simple problem that we looked at a few slides ago. So imagine now that you retire at time 0, so that's age 65, and you have a 30-year horizon. Generally speaking, you're going to care about shortfall over pretty much that entire horizon. So that's really what's indicated by the red shading here. In this example, you care about shortfall starting 1 year after retirement. So to actually come up with a glide path, we need to make an assumption about what asset classes we're going to invest in. And here we're going to expand our bond concept to split bonds now into short bonds and long bonds. The idea is that as you age, as you get into your 80s, for example, shorter duration bonds are likely to become an increasingly important part of your portfolio. And we're also going to add in alternatives. Alternatives are also they're higher turnover strategies, so they have a duration that's also shorter. In this case, we model them as a 2-year duration. But there's another thing that we do with alternatives here. If you can see, the return volatility here is 8.8%. That's what we're assuming. That's far higher than we've experienced in the alternative strategies that we've run over the last 10 or 15 years. And there's a couple of reasons for this. One is we don't think we've necessarily seen in the historical record that we have all of the outcomes that we might expect to see in the future. And the other reason is related to this last line here, which is the volatility of expected returns. If you remember the decomposition that we made, returns are expected returns plus unexpected returns. As your horizon grows, the volatility of your expected returns becomes an increasingly important component of the volatility of total returns. So while we have very strong confidence in the long-run expected returns that we're going to get from stocks because we have confidence that capitalism is going to hold, for these alternative strategies, we have less confidence in our assessment of their future returns as the horizon increases. And that's being captured by that 4.4% expected return volatility. Then we make some reasonable assumptions about what the correlations are. When we turn the crank and we end up with a glide path. And rather than being flat, as you would expect to see if we were taking a human capital approach, we see a lot of structure to this glide path. So for example, when you retire and you have a 30-year horizon, that's the portfolio all the way on the left, you have a little bit less than 60% of the weight of your portfolio in stocks, and roughly an equal mixture between long bonds and alternatives, slightly more weighted to long bonds and alternatives. As your horizon shrinks, your weight in stocks falls, as we'd expect. And at about the 15-year mark, the short bonds start to play an increasingly important role in the portfolio. And by the time you get to about age 94, they really start to dominate the portfolio. We think this is a very intuitive set of portfolios, much more intuitive than having a constant glide path. Constant glide path is what you'll find if you look at one of the top providers. There, what we see, the defining characteristic of this set of portfolios is that the weights are basically flat over the majority of the investment horizon. Now, there's nothing wrong per se with this. This is good for somebody. The problem is we don't know who it's actually good for because we don't know the specific assumptions that went into it. And again, it's predicated on this idea that your human capital is zero. The virtue of our framework is that the problem is being framed in a very specific way. What do you need and when do you need it? And that's what's driving the shape of the portfolios. We could probably, if we tried hard enough, come up with a framing that actually generated this, but it would probably be in a very narrow set of the kind of investor preferences. So what we can do now is we can ask the question, well, let's compare some of the basic characteristics of these two particular glide paths. And let's start by focusing on the table at the top. So what we're going to do is we're going to say, I retired at age 65. What's my expectation about my expected shortfall? Remember, I want to compound at 3% over the next 30 years. If I take all of the portfolios that I expect to own over that period, what's my average expected shortfall over the next 30 years? So that is the first column, the expected shortfall column. Now, in our framework, we've optimized over expected shortfall. So we have an average of 2.8% per year versus the competitive glide path, which is 5.9%. Now, if we didn't have a lower number, it would mean we've done something wrong. We've optimized over this particular. But it's the difference is large. The expected shortfall is not necessarily the most intuitive way to think about the expected shortfall of 2.8%. A more intuitive way is to actually split it into two pieces. We can say, what's the probability, the average probability that we fall short, and what's the average magnitude that we fall short if we do happen to fall short? The 15%, that's the probability that we fall short. That's much lower than the 27% that you would get from the competitive glide path. The expected shortfall, if you fall short, in our case, is 18% versus 22% in the competitors. So by construction, this is the metric that we are actually superior on. But fundamentally, the reason that we're superior is because we're asking the right question. Risk is not having what you need when you need it. The last column is also interesting. This is your expected surplus. Now, if you recall all the way back about 15 slides ago, we have a utility function where we say you're equally happy for all levels of wealth above your target. But we can still measure how much expected surplus you have. So in our framework, you get a lot more expected surplus. Now, this can be useful for a number of reasons. We haven't accounted for longevity risk. Having a higher expected surplus naturally accounts for that. So even though we don't directly incorporate it into the framework, this is potentially a really useful byproduct. But it feels like we're having our cake and eating it too, and there's no cost to having this kind of extra surplus. So in order to understand the cost that you're bearing or the price that you have to pay in order to have your cake, which is this lower expected shortfall, and eat it too, which is this higher expected surplus, let's go back to kind of the conventional lens and ask, what is, for the portfolio that we're going to own at age 65, what is the expected one-year return and expected volatility of that portfolio? And that's in the bottom panel here. So what we see in our approach, the expected return is higher, 5.1 versus 4.6, and the volatility is also higher, 10.2 versus 9.3. So this expected surplus is coming at a cost. You're not getting it for free. But the cost that you're paying is effectively volatility. It's the price that you're paying. We think that's a really good trade-off because volatility is not risk. Risk is not having what you need when you need it. So to summarize, you can have your cake, which is lower expected shortfall. This accounts for both the probability and the magnitude of shortfall. And the reason I emphasize this point, it's especially true in the retirement problem. A lot of retirement providers will optimize to minimize the probability of shortfall. But magnitude also matters, and this framework allows you to account for both the probability and the magnitude. If your horizon is long enough, not only can you have your cake, but you can eat it too. Now that comes at a cost, and that cost is higher volatility, which we think you should be willing to pay based on your investment horizon. So to summarize, we've introduced a framework that has really been oriented around thinking about not having what you need and when you need it as being your investment risk and framing that in dollars and cents. But we've also applied this framework to non-kind of absolute return problems. We've applied it to relative return problems as well. For example, let's suppose you are deciding how to allocate between equity strategies, and your goal is to beat the S&P 500 by 150 basis points a year. How do you decide how much to allocate to a variety of different equity strategies? Well, you can apply exactly the same approach. You don't apply it in absolute space, you apply it in relative space. But all of the ideas about the benefit of being able to extend your investment horizon if you can, having your cake and eating it too, apply in really exactly the same way. So with that, I'll open it up to questions. Yes?
Does this approach contemplate sequencing of risk? So a chance of a major drawdown right before you hit retirement?
It gives you a natural way to think about how you would react to that situation. So sequencing risk is just a fact of life. You can't avoid it. The returns are going to be what they are. What this approach suggests that you should actually do is periodically, frequently, you should reevaluate your needs and circumstance, re-optimize, and then rebalance to the most appropriate portfolios based on what your new needs and circumstances are. So let me flip the question around just a little bit to kind of reframe things a little. Let's suppose you said, I have $1 today, and I want $1.50 in the future, 5 years from now. Well, let's suppose you find $1.50. Now, you really needed that $1.50, and you find it. Well, you should account for your new information, and you should re-optimize and rebalance your portfolio based on the fact that you now have $1.50. Reframing it as saying, I already have what I need, removes the kind of emotional baggage that goes along with saying, well, I have $1, I need $1.50, I had a really bad return, now I only have 50 cents. If you really need that $1.50, you should re-optimize to a much higher target compounding rate and rebalance appropriately. So this framework gives you a way of thinking through how you should behave if you have either really good unexpected returns or bad. And we've done a lot of research on that. It makes a big difference. I did not talk about the, right. So one question that you could ask is you could say, well, should I buy insurance? Okay? Should I go out and buy puts on the market as a way of insuring against a drawdown? And the short answer is no. And the reason is because if you look at what the cost is to reducing your equity exposure, you pay so much in kind of return loss that the better approach is to simply reduce your equity exposure to a level that you would be comfortable with if you had a really bad market event. So if you said, I can't tolerate, like if the market fell by 50%, this is how much I could afford to lose in my equity portion. You put a constraint on how much equities you could own at that level. That will be far superior than buying insurance in the form of options or puts. So we've done a lot of work on that if you're interested in the details. Yes? So I'll try to say it in words, and there's a formula that's in the appendix, but I'm going to try not to go there. So the expected shortfall. So you remember we have a distribution of outcomes. You pick your target, say it's at some level. You look at all of the possible outcomes where you fell short. You take the probability of that outcome and you multiply it by the utility of that outcome, because you have a utility function, and you just simply add it up over all the possible values of shortfall. So it's the probability of shortfall times the utility of shortfall added up over all shortfalls. Exactly the same for surplus.
Any other questions? Okay. Well, thank you, Martin, and thank you, Matt, and thank you all for your time and for your questions.